Welcome to Forex 101. This is your step-by-step guide to understanding the exciting world of Forex trading. Before we dive in, make sure to subscribe to our channel and hit that notification bell. That way, you won't miss out on any of our new content. Today, we're tackling a fundamental concept major, Forex pairs. These pairs are the heart and soul of the Forex market, and understanding them is crucial for any aspiring trader. So, let's get started. In Forex trading, we don't buy or sell single currencies. Instead, we trade currency pairs. This means we're always looking at the value of one currency another. Think of it like exchanging money when you travel. For example, if you're exchanging US dollars for euros, you're essentially trading the EUR-USD currency pair. The first currency listed, EUR, is called the base currency, and the second USD is the quote currency. The exchange rate tells you how much of the quote currency you need to buy 1 unit of the base currency. Now let's talk about major pairs. These pairs are the most traded currencies globally, representing the world's largest and most influential economies. They are characterized by high liquidity, meaning there are always plenty of buyers and sellers, which makes them easier to trade. Major pairs typically involve the US dollar, USD on one side, as it's the world's reserve currency. Understanding these pairs can give you valuable insights into global economic trends and trading opportunities. The EUR-USD is the most traded currency pair in the world. This pair represents the economies of the Eurozone using the euro and the United States using the US dollar. It's known for its high liquidity and relatively tight spreads, the difference between the buying and selling price. Factors influencing this pair include interest rate differentials between the European Central Bank, ECB, and the US Federal Reserve, as well as economic data releases from both regions. Section 5, USD JPY, a safe haven dance. Next up, we have USD JPY, representing the US dollar and the Japanese yen. The yen is considered a safe haven currency. This means that during times of global uncertainty or risk aversion, investors tend to flock to the yen, increasing its value. This pair is heavily influenced by global risk sentiment, economic data from both countries, and the actions of the Bank of Japan, which sometimes intervenes in the currency markets. Section 6, GBP USD, riding the cable's waves. GBP USD, also known as the cable, is another key major pair. This pair reflects the relationship between the British pound and the US dollar. It is known for its historical significance and its potential for volatility, especially around major economic or political events in the UK. Traders closely watch UK economic data, such as inflation and GDP growth, as well as the Bank of England's monetary policy decisions, for clues about the direction of this pair. Section 7, USD CHF seeking stability. The USD CHF pair involves the US dollar and the Swiss franc. Like the Japanese yen, the Swiss franc is also considered a safe haven currency. This is due in part to Switzerland's stable political system and strong financial sector. This pair often sees increased demand for the Swiss franc during times of global uncertainty, leading to potential trading opportunities for those watching for safe haven flows. Section 8, USD CAD, the commodity connection. Last but not least, we have USD CAD, which represents the US dollar and the Canadian dollar. Canada is a major commodity exporter, particularly in oil and natural gas. Therefore, this pair is heavily influenced by commodity prices, especially crude oil. When oil prices rise, the Canadian dollar often strengthens against the US dollar, and vice versa. Traders also keep an eye on interest rate differentials between the US and Canada and the overall health of both economies. Section 9. Advantages of trading major pairs. Focusing on major pairs offers several advantages for traders. High liquidity. Major pairs are traded in large volumes, making it easier to enter and exit trades quickly at desirable prices. Tight spreads. The difference between the bid and ask prices is typically smaller for major pairs, reducing trading costs. Abundant information. There's a wealth of information and analysis available on major pairs, helping traders make informed decisions. By understanding the dynamics of these key currency pairs, you can begin to navigate the Forex market with greater confidence. Thank you for reading this article. Remember to like, share, and subscribe to this content. Till next time, bye.